David Cole here, your trusted realtor and lender. Today we explore the likelihood of a September Federal Reserve rate cut amidst below-trend growth. While market confidence is high, it may be misplaced. We'll analyze economic conditions and assess whether the Federal Reserve will act, setting the stage for a deeper dive into market expectations and economic indicators. Federal funds futures suggest over 90% probability of a rate cut, but this confidence is excessive. Economic indicators don't strongly support immediate Federal Reserve action. Cumberland Advisors believes the market's conviction is misplaced as the economy shows below-trend growth without outright contraction. Investors should be cautious about expecting a September rate cut. Cumberland sees the odds of a rate cut as closer to 50-50. Inflation reports could deviate from the Federal Reserve's 2% target, and labor market resilience suggests a potential delay in rate cuts. Investors should prepare for the possibility that the Federal Reserve delays cutting longer than markets expect. Tariff and service sector inflation could appear in upcoming Consumer Price Index, Producer Price Index, and Personal Consumption Expenditures reports, potentially raising trend inflation. This might reduce the Federal Reserve's easing momentum. However, if employment data weakens significantly, a September rate cut could be justified. The Federal Reserve remains committed to a data-dependent approach, assessing each meeting individually. The labor market is softening gradually, with stable jobless claims and low unemployment. Manufacturing weakens, yet the service sector expands modestly. Companies retain workers despite economic slowdown, complicating the Federal Reserve's assessment of labor slack. This dynamic may influence the Federal Reserve's decision on rate cuts as they await conclusive data before policy changes. Low unemployment complicates the Federal Reserve's assessment of labor slack as they prefer conclusive data before policy changes. Upside inflation surprises and job growth may delay rate cuts. This cautious approach reflects the Federal Reserve's data-dependent strategy, emphasizing the need for clear economic signals before adjusting rates. Short-end rates may remain stable if no rate cut occurs. Intermediate and long-term rates could rise slightly, offering investors higher yields before eventual cuts. This scenario suggests opportunities in the bond market, but also highlights the need for caution as the Federal Reserve's decisions remain data-driven and uncertain. The Federal Reserve is expected to win the inflation battle and slow the economy. However, a 90% confidence in a September rate cut is overly optimistic. Portfolios should be prepared for uncertainty in the rate path. The Federal Reserve's decision remains entirely data-dependent, emphasizing the need for vigilance in monitoring economic indicators. I, David Cole, would be excited to be a resource for your home buying, home selling, and any kind of financing need you might have. Scan my Linktree to schedule an appointment today. Also, you can call or text me at 4257-771-509. Thank you and look forward to being a resource. Be sure to like and subscribe for more relevant videos and education.